Everybody, thank you for coming today. We have a good crowd online, so we're using this mic to talk to our online folks. For those here, thanks for coming today. We are having some intermittent internet issues. We're running this off of a phone for those of you online. So if you do run into technical issues, know that we are going to send you a recording of this later this afternoon when we've completed. First, I wanted to introduce all the advisors and the other staff. Kurt Pearson, I think people know who Kurt is. Justin Van Houten, over there. Steve Connard. Michelle Bjorkren. Where'd Michelle go? Oh, she's right in the back. Couldn't see her. Alan Holstein. There he is. Julie Greer. Hannah Mason, our newest employee. Welcome, Hannah. Joe Waniger. And Cheryl Hurst. Didn't miss anybody. Well, my name is Guy Lehman. Oh, yeah, we have our person that's running all of our technology here, Caleb Pearson, of course. Yeah, I always forget about you. Today, Kurt's going to lead us out in an intro. We're going to talk about many of the hot topics that we have clients bring up again and again. Inflation. We're going to talk about interest rates. We're going to talk about the recession, what a recession is and how it's measured. We're going to talk about the health of the consumer with some data that we have. Steve is also going to spend some time talking about our investment committee process and how that works. We're going to get a real brief update from, we're going to read a real brief update on real estate, local real estate, farm real estate, and someone from the accounting realm, so from a CPA. And then we welcome Dan Holtkamp here from JP Morgan to give a little outlook on financial markets going forward. So Kurt.
Thanks, Guy. Well, economists notoriously have predicted 9 of the last 3 recessions, right? You catch that? This time they may be right though, right? In fact, we already know that we've had 2 quarters of negative GDP growth, and that's the typical definition of a recession. And if you read the headlines at this stage in the economic cycle are always interesting because they make believers out of all of us when it comes to how tough things are. Although my favorite restaurants seem to be doing just fine because I have to wait to get in. That's my barometer on a recession, right? But it reminds me of Peter Lynch, who long ago when I first started in the industry, I saw this quote by Peter Lynch. It said, "Now is always the hardest time to invest." And that is so true because there are always headlines, things going on that make you pause and make you wonder, hey, what should I be doing with my money? Investing is always a contrarian adventure. All right. When you're feeling really good about your investments, that's probably when you're at the most risk because things are high. You're like, wow, look at how things are going. This is great. I've got this figured out, a bit euphoric. Then as things begin to taper down, you're like, well, maybe I don't have it figured out. And then a little bit of fear creeps in. And then as it starts heading to the bottom, you're like, oh man, this is discouraging. I'm in a world of hurt, right? When you're feeling the worst about your investments, that's when you probably have the greatest opportunity because there are things to look at. There are opportunities, there are great values. There are things that you want to take advantage of. Our role as financial advisors is to help level out those emotions because anytime emotions are involved in a financial decision, whether it's investing or something else, you have a recipe or the potential for a mistake. The best financial decisions are when you begin to make those decisions based on logic and you have your own emotions off to the side. Easier said than done. The biggest investment I made for many, many years was reinvesting in the company, right? Now that's not the case. I have my own diversified investment portfolio. I'm looking through things with a little different lens. You know, I have to start following my own advice, and that's just a little bit different. So I hope you find a lot of value in the presentation today. Our other advisors are geared up and ready to roll. Justin, I think you're up next. Talking about inflation, right? All right.
Thanks, Kurt. So today we're just going to talk about some different areas of the economy and really what are the impacts for you? What are you guys seeing? And of course, inflation is on the top of everyone's mind. It's something we've been experiencing going back to 2021 even. If you go to the grocery store, if you're getting gas, right? And the interesting thing with inflation is, I can choose where I go shop for groceries. I can go to Hy-Vee, I can go to Fairway, I can go to Aldi's. You can't choose whether you want to participate in inflation. You can't opt out of it. You can't elect out of it. It affects all of us. And I thought I would start and just maybe tell you, well, what's the official definition of inflation, right? So inflation is the rate of increase in prices over a given period of time. So when you hear people talk about inflation, they're always comparing it to a prior time, year over year. This January compared to last January, right? Well, what is the cause of inflation? A simple way to think about it is it's when you have too much money chasing too few goods, right? So if you think back to your old supply demand, and then you think about all the money that's out there right now, and there's a couple ways inflation is measured. So you may see in the news or read headlines where they're talking about CPI or PPI. And a simple way to think about that, CPI is the consumer price index, PPI is the producer's price index. And basically they're taking a sampling as a consumer of, if you go to the store and buy goods and services, what rate increase is that this year compared to last? And then of course, on the producer side, if you're producing something, what rate increase have you had in your inputs that you're then passing along to the consumer? So that's just some terminology for you. If you see those things in the headlines you're reading and you're curious what they mean, PPI is kind of interesting because it's a leading indicator for CPI. And if you think about it, if as a producer, if you're producing something and your input costs go up, definitely when you pass those along to the consumer, they're going to pay a higher price. And so you see that there. So how did we get here? Well, part of it is just physical policy, how our government, how the Federal Reserve chooses to handle these situations. And in terms of like, sometimes they might just print money if we need money. That's something that's out there. But what I want to talk about a little more today is what happened coming out of COVID. Because if we go back to COVID in the year 2020, supply chains were disrupted, right? Things were shut down. We had boats sitting out in the ocean. People couldn't get what they needed. Okay, so when you think about that supply demand dynamic, our supply was not meeting our demand. We had the shortage on toilet paper and any other number of items, right? So we already had the first ingredient there with not enough demand and too much supply. Coming out of COVID and coming out of COVID, there was a lot of stimulus, right? There were the PPP loans for businesses. There was the stimulus that went out to consumers, that went out to people's households. Well, that, and that's the physical policy, right? There was money that was sent out, money that was created and pushed out into our system. So now you have that recipe of too much money chasing too few goods. And so as that worked through the system coming into 2021, that's when we really started to see inflation take off. Just to give you a point of reference, I wouldn't compare COVID to the last major financial crisis we had. So the 08-09 crisis, they're apples and oranges. But something that's interesting is the amount of stimulus that was put out into our economy after COVID was 40% more than what was needed during 08-09. And the other interesting thing with that is in 08-09, it was all contained within the banking system. So it didn't make it out to individual households like it did this year with coming out of COVID. So there's a couple things there. I think the last thing I would say about it is we're starting to see signs of the supply demand getting back in balance. So some of that is supply chains coming back online. Some of that is what Michelle is going to talk about next, which is how do we have inflation going on. We have too much money in the system. How do we correct that? How do we pull money out of the system? And essentially what the Federal Reserve is wanting to do is create demand destruction, meaning less demand for items because they cost more, right? So that's my piece on inflation. And so Michelle's going to have the answer for you on how do we correct that.
Yeah, no kidding. So I'm going to take a little bit deeper dive into interest rates. Super, super fun topic to talk about. So the control of interest rates falls under monetary policy. Can you guys all hear me? Okay. Monetary policy is a way to control the money supply, what's being spent, and hopefully stimulate economic growth. And it is governed by the Federal Reserve, fondly known to us as the Feds. So not to be confused with fiscal policy that Justin talked about. Fiscal policy is governed by the president and the Congress, and they actually focus more on taxation and federal spending. We're going to talk about money supply, what we spend, what we don't spend, and how that all works. So I'm going to give you the who, the what, and the how of monetary policy real quickly and how it affects us right where we're at today. So who? The Federal Reserve. They are a committee designed to promote the effective operation of the U.S. economy. That's their job. What? Help manage the money supply. Stimulate or loosen the money supply in our economy, or tighten it up and hopefully avoid inflation, or at least, dampen inflation. So how do they do that? The Federal Reserves have three main tools in their tool belt to manage, control money supply. I'm going to talk about the first one is interest rates. We're hearing about that right now. We have been the last 12 to 18 months. Interest rates are on the rise, little by little by little. It's the most common use to try and control money supply the Feds have. So think about that. If they raise interest rates, all of a sudden we stop and say, wait a second, it's going to cost me more to buy a house, cost me more to buy a car, take out a loan, take out a new credit card. And we're going to stop and say, you know what? That doesn't work for me. So that tightens the money supply in our economy. The Feds can lower the interest rates, which we've seen historically in the past. And that gets us all excited because then all of a sudden we can buy a new vehicle we've been waiting to buy. It's not going to cost us as much. We can buy a new house, not going to cost us as much. We can take out a loan, etc. That is loosening the money supply and pushing more money into our economy. The second way the Feds can control money supply is through buying and selling of securities. So to keep it simple, if the Federal Reserve wants to sell securities, typically treasuries, to the public, they're going to sell those treasuries. We're going to pay for those, which puts less money in our pocket and less money to spend, i.e. tightening the money supply. If they want to buy securities back from us, they are going to give us money for those treasuries, those securities, putting more money in our pocket. Then we get to go spend more money, take out another loan, open another credit card, buy a new house, and we're comfortable with that. Finally, bank reserve requirements. Banks have a level of reserve that they are required by the Federal Reserve to maintain. So that means basically in the back room, they got to have this bank of money to be able to fulfill requests for overnight loans to other banks, consumer loans, etc. If the Federal Reserve says, we're going to increase your reserve requirement, what does that do? That obviously reduces the amount that banks can loan to us. So what do? We say, okay, we're going to wait because we can't buy a new car, buy a new house because there is not money to be had. So it tightens the money supply. If the Federal Reserve reduces that bank reserve requirement, money is flowing. And all of a sudden we're like, okay, banks have more money to give us. Let's start spending more. Obviously, then we are loosening the money supply. So with all that really exciting information, right now interest rates is our reality. We've seen the last 12 to 18 months, the Feds have very incrementally increased interest rates to try and tighten, get a hold of our economy to hopefully keep inflation at bay. They're still trying to do that. So how does it affect us right where we're at? So you guys are asking the questions when you come in to see us. You're like, you know what? The credit union down the street, they're offering me a CD for 4.25. That's more than we've seen in quite a while. And so that's an ultimate result of what's happening. But also we're seeing things being more expensive. We are seeing higher interest rates on credit cards, higher mortgage rates, and along those lines, just to wrap up. So the interest rate that is controlled by the feds is one thing. Mortgage rates that you see when you want to buy a new house, that is determined a little bit more, driven a little bit more by supply and demand. What's out there? How many houses are available? What is the turnaround time for buying and selling a house? So what the feds decide to do does not ultimately overnight affect your circle, your personal space. It takes a while to trickle down, but it does ultimately affect our decisions. Thanks.
Thank you, Michelle. I'm going to talk about the R word, recession. We just went through a midterm election cycle, and one side of the aisle was talking a lot about, hey, we're in a recession. Look at prices. Look at this inflation that Justin just talked about. Look at what interest rates are doing. We're in a recession, and I'm here to tell you that we haven't experienced a recession yet. Kurt misspoke, I think, a little. He talked about the definition of a recession being 2 consecutive quarters of negative economic growth. And we did experience 2 consecutive quarters, the first and second quarters of 2022, where, according to the Bureau of Economic Analysis, the government unit that measures and tracks the economy, we did in fact have a contracting economy measured by GDP, gross domestic product. But that measure is not perfect. There is not it misses a lot of the economy. And I'm going to get into that in just a minute. But the fact that we had 2 consecutive quarters of growth by just that, of negative growth just by that measure, there's a lot of evidence to say that, we really truly haven't entered recession yet. So I'll talk about GDP. GDP is gross domestic product, but that measures the final output, what we buy in the stores and what, how much of that activity, but it misses 2/3 of the economy. And the 2/3 of the economy that isn't captured in GDP data is what goes on at the stages of production before all the stuff we buy ends up on the shelves available to carry out of the store. That is business to business spending as goods and services move through the supply chain. And that is not captured by GDP. That is captured by a measure known as gross output. And it was only in 2014, less than a decade ago, that the government began to track gross output. It's for many years, there's been a school of economics called the Austrian school that has always advocated for gross output to be the official measurement for economic activity because it captures the entire economy. You've probably all heard that the consumer spending in America accounts for about 70% of the economy. Well, that is true measured by GDP, but it's only 1/3 if you measure it by gross output. And so I find it interesting that it's been less than a decade since the government decided to even track gross output, but the pressure on them to do so, and the fact that they finally began to do that, tells us that they see it as important to actually get a true read on what the economy is doing. So let's go back to the first half of 2022. By GDP measure, in the first half of 2022, adjusted for inflation, gross domestic product fell about 1.9%. But during that same period, gross output rose. Again, on an inflation adjusted basis, it rose over 2%. And it would be almost impossible for an economy to be in recession with gross output still growing. So we have to look at how they measured it. There is a slide here that shows another way to measure economic activity in general. And they call that high frequency data. This stuff gets measured every week. You see how many people are applying for unemployment, how many people are remaining on unemployment who filed earlier, how many people are staying in hotels, how many people are flying as measured at TSA checkpoints, how many people are going to the movies. And you can't see this data up here. You don't need to see it. But one of the one thing we've been monitoring is how has this high frequency activity compared to what it was before we even knew what COVID was. In other words, to go back to 2019 and compare this data with 2019 levels, and across the board, we see it's actually higher than it was before COVID came on the scene. So that tells us that people, haven't really slowed down their spending. There was a lot of pent up demand when when the economy was locked down and people couldn't do anything. And that certainly plays into this, but high frequency data also belies that there was actually a recession. We haven't been there yet. Doesn't mean we're not heading there. The Fed and other central bankers around the world seem to not fear their actions with interest rates producing a recession the way they have in the past. But typically you're not going to see high inflation. Usually you don't see inflation at all with a recession. You usually see prices going down. But we've seen high inflation when they're claiming there's a recession. And so our position here is that we haven't seen a recession yet, but that doesn't mean that we won't. Thank you.
We're going to talk about consumer confidence next. And really, what are the things that consumers really care about? Right? Number one, their job. Do I have a job? Do I have good job prospects? And do I have good prospects for income growth over time? Number two, do I have extra money? Can I have a cushion against life? Right? We're going to look at those. Number three, what about my housing situation where I live? Can I afford a house? Can I afford to move up? Can I get my family what I need to? And the number four thing we're going to look at is how all that wraps up into consumer confidence. So go ahead and hit the slide. So number one is the job. We have two lines here. Is the dark line shows the unemployment. And you can kind of see most recently here, this actually goes back over about 50 years. And you can see various peaks and valleys in the black line. Most recently, April of 2020, in the midst of coronavirus, unemployment got up to about 15%. Today, it's down at 3.5. Okay, what a turnaround. This is amazing. In fact, 3.5 is an all-time low. Now, what we have going on here is a chronic labor shortage. And this chronic labor shortage actually started back in the 08-09 recession, and where baby boomers bailed out the U.S. economy because they worked at a higher rate more baby boomers joined the workforce after that recession than any other generation before it. It had a higher employment rate of any other generation prior. So drove the economy for many, many years. But baby boomers, there's 76 million of them. The youngest are 60. The oldest are 77. So almost all the baby boomers have retired or will be very shortly. So the retiring baby boomers is one of the big reasons for the chronic labor shortage. And this is not going anywhere. We're going to be dealing with this in the US for a long time. In fact, Generation X that comes right behind it is 55 million, a full 20 million people smaller than the baby boom generation. Okay, so along with job prospects, which right now look very, very good for the remaining workers, wages look very good too. For many, many years, you see the blue line, workers could expect between 2 and 4% wage inflation every year. Well, since 2018, that's bumped up. You know, there were some big swings with coronavirus, but it bumped up above 6% and has pulled back a little bit. But frankly, for the remaining workers, all signs point to a great job market and positive income in the future. Now, for the first time in my lifetime, low skilled workers their income is going up faster than high skilled workers. Really interesting switch, because that hasn't been true for a very long time. Next thing we're going to look at is savings and having extra money.
I'm going to touch on consumer debt spending and their savings rate. In the top right-hand corner, we see a 40 years charted here of the discretionary income that households are receiving and what percentage of that income is leaving their house to pay debt. And this is at an all-time low of around 10%, meaning that consumers are keeping more of the income they earn in their pockets and available to spend elsewhere. Below this, we compare it to consumer savings. Pre-pandemic, households they were pretty much flat with savings. They weren't adding to savings, they weren't dipping into savings. Enter the pandemic, a lot of people are staying home. They're spending a lot less, and on top of that, they might have received stimulus. This allowed the consumer to build a buffer of savings roughly equal to $2 trillion. We move into 2022, as we all know, inflation has been very high, and the consumer now has to dip into that savings buffer. But even that being said, they still have about half of that buffer remaining, so $1 trillion as a safety net going into 2023. When we compare these two signals, we could say that the American consumer is actually in a better position now than they were pre-pandemic. And Guy's going to touch on housing.
Thank you. We're going to look at the housing chart on the upper right. You know, a lot of people know this information anecdotally, but it's interesting to see the data. And this chart is a housing affordability index. So a higher number means more affordable, and a lower number means less affordable. There's two major things that have happened in the last couple of years that have made houses much less affordable than they were even a few years ago, right? First one is coronavirus. It made people say, hey, I don't have to live in the city anymore. I can go live somewhere else and work from home, right? So that shot a lot of people into the housing market. And when you have a lot more demand and the same amount of supply, prices go up. There's bidding wars. It got a little crazy, if you remember. That was the first leg down. The second leg down happened in 2022 when you heard Michelle talk about interest rates. So mortgages went from about 3.5%. At their highest, they doubled up to 7%. And Alan, what would an example be? How does that affect affordability?
Yeah, if we picture an American household who has a monthly budget for their mortgage of $1,500, and they were looking for a home last January, so 1 year ago, they could be looking at homes valued at about $334,000. We fast forward to today, interest rates have almost doubled, and now that same family, same $1,500 budget, can only look at homes worth $242,000. So that's about $92,000 less that this household with a $1,500 budget can afford.
Yeah, that's a big deal, isn't it? That's a lot of house you can't afford today that you could afford a year ago. Now, with this decrease in housing affordability, it's pushed a lot of people into the rental market, right? How is that market looking? There's a couple things. The rental vacancy rate over here, has come way down in the last 10 or 12 years, and it sits below its long-term average. It's about 6%, just saying most rental units are occupied. And primarily because owning a house now has gotten a lot more expensive than it was a year ago. Coinciding with that, this is multifamily housing start, so apartment buildings right here. Over the last 10 years, we've seen a great increase in apartment building by builders, okay? Because a lot of people are getting priced out of the housing market, and it's sitting at a generational high right here. Not quite so with single family housing, and we're going to get an update on real estate. The 08-09 crash really took this down, and it has climbed back up, but it's taken another leg down here. So these sort of things are years and years in the making. So when we look at the consumer as a whole, you're going to talk about consumer confidence. So all these things feed into consumer confidence.
Yeah, we've talked about some good points we're seeing and some bad points, but it really boils down to, how is the consumer feeling? Are they optimistic or pessimistic about the future of the American economy? What we see on this chart on the far right-hand side is we ended 2022 at an all-time low with consumer confidence. This means consumers are fairly pessimistic about the future. They might be changing their spending habits, putting off big ticket purchases. If they need to change a job or move, they're delaying those financial decisions. And the reason we point this out is that even though it's a low data point here, confidence is low, from the investor perspective, it's not necessarily a bad thing to see.
This chart kind of overlays, this is a chart of consumer sentiment. But what it does is it takes these low points, and it says, what are the stock returns in the US market over the next 12 months after we hit a low? And almost all of them are really excellent and above average. So again, there's no saying that history repeats itself, but there's a long track record here of it. It's kind of a contrarian signal. It's going against the common wisdom out there. So we bounced off of a really low. Now look how much lower it was than the bottom of coronavirus. I think we need to take a moment and realize what we went through. Remember that feeling when the US economy shut down? Do you remember that? It was the strangest thing that I've been a part of in my life. And we forget what it's like in that moment in time. Nobody knew what was going to happen. We didn't know what we were dealing with. And we're quite a bit below that now, primarily because of all the things we've been talking about. So it's a mixed bag for the consumer right now. Great job prospects, a growing income. They have some money in the bank, but not quite as much as they had 2 years ago, but way more than they had 3 or 4 years ago. But houses have gotten too expensive. I can't buy as much house as I want. And we're really not feeling all that great right now about the future. So again, it's really tough to read. The tea leaves are very murky right now. With all this, I'm going to have Steve come up, and he's going to talk about our investment committee. We've had a lot of questions over the years about how we work and make decisions in this environment.
Thank you, Guy. So about 6 years ago, we started to kind of centralize the way that we make investment decisions and create a firm-wide investment policy, where before that, each advisor kind of did their own thing. And so we decided to unify that effort, and we created the investment committee. Raise your hand, Compass advisors, if you're on the investment committee. So there are 4 of us. And so the vast majority of our client accounts are assigned to one of 15 model portfolios that are proprietary to Compass. We developed them ourselves. We feel like there is a solution for every investment objective within those models. They are proprietary. We do not farm any of this out. We make all the decisions, and we're very active. How active? Well, we meet weekly. We meet every Tuesday morning, and during those meetings, we look at a lot of things. Just a kind of a list of them. We look at last week's market performance. How did the markets do? Not just the stock market. We look at the bond market. We look at interest rates, and sometimes some other asset classes as well. Then we look at how well did within whatever the market did with it, whatever the context was, how well did our 15 models perform? We're looking for, why did they perform the way they did? We're looking for signs that they're behaving the way that we would expect them to based on their design, given what the market backdrop was for the week. We're looking at trying to figure out, well, what drove the markets? Why did they do what they did? How are the positions holding up? So we're looking not only at the model level, how is the model performing? Is it performing the way that we would expect it to, but also each position that we own. And we're using those meetings to make decisions. Are changes needed in any of the models based on new opportunities we're seeing or different risks that have started to rear their heads and that we want to avoid? So those are some of the things we do during these meetings. But outside of the meetings, we're all very involved in product due diligence, making, always looking for investment solutions that can help us execute our investment objectives in each of the models. So we're always looking at new products, different products, vetting them. We're doing research on markets and trying to learn as much as we can about the environment that we're dealing with. These models, there are three basic types. There are growth models, there are income models, and there are a couple we call volatility models. Those are for people who just don't, they don't have a lot of risk tolerance. And so we're trying to generate a respectable return without taking a lot of risk. And so, those are the types of models we have. We have subtypes of models. Many of our clients need income, and they're in our income models. We have tactical versions of income and growth models. And what I mean by that is there are some people who don't want to take whatever ride the market decides to give them. And so we have versions where we draw a line in the sand. And we say, okay, if the model goes down this much, we're putting it in a holding pattern. So we have we call those our tactical models. Those of you who are in tactical models, you've probably seen a little more trading this year than you might typically expect to see when those trade confirmations come out. But that's what we're doing here. We're just looking for the best solution. The whole idea, though, the big idea is when you're working with your individual advisor, they're looking at each of your accounts, and the key thing that they need to do for you is identify what you need your money to do for you and to properly assign your accounts to the right models so that there's alignment with how your money is invested and what you need that money to do for you.
Thanks, Steve. So I'm just going to give you a quick update on Guy and Alan talked about real estate on the charts they showed, and that was kind of at a national level. And so I'm going to give you a local update from the Iowa Association of Realtors, just some kind of interesting numbers. And if you're in the situation buying, selling a house, or you have friends or family that are. So November of 22 single home sales compared to November of 21. This is the most recent data we have. It came out the end of December, so it's November's data. We don't have December's data yet. Home sales were down. If you compare November that just happened to November 21, they were down 29%. So not surprising when you think about what we've talked about with interest rates and mortgage rates, and buying a home has become more expensive, right? That's why you see more people looking at rentals. Overall for 2022, if you compare it to 2021, home sales, and when I'm talking locally, I mean the state of Iowa, home sales were down 9%. So what that shows you is the beginning part of the year when rates were a little more reasonable, there were still some good sales. And then as rates rose throughout the end of 22, they started to kind of fall off a cliff a little bit. Interest, I think this is interesting. The median sale price for homes, if we're comparing 2022 to 2021 for the state of Iowa, was down 0.5%. So you would probably expect more. But what that tells you is if you think about supply demand that we've talked about a lot today, there was prior to COVID, and really if you go back to 08, 09, there's been a shortage of new builds for housing. Builders didn't want to get burnt. They got burnt during 08, 09. They didn't want to overbuild. And so we already kind of had a supply demand imbalance where there was more people, especially if you think about some of the cities in Iowa. So around here at the metro, over on the eastern side of the state, western side of the state, there's a lot more demand for housing than what the supply was. And so even though rates got higher, even though home prices were higher, there was still so much demand that the price held really steady. So that's kind of interesting. Townhome and condo prices did go up 10% year over year. So they did become more expensive if someone was looking for that option as opposed to a single family home. In terms of supply, so going back to May of 22, the overall supply of available houses in Iowa was a little over 5,200. By the end of last year, so going to November, the supply was 6,900. So that supply is increasing. That will be a good thing for people that have kind of held off buying and are waiting for maybe 2023 because maybe now they have a little more leverage as a buyer. Average days on market. So a measure of how long does it take to sell a house. For homes in 2022, average days on market was 32. At the beginning of the year, it was single digits when the market was still really hot and going back to 2021. But it was 32 by the end of last year. It was a little bit longer for townhomes and condos. 44 days was average days on market. And the last thing that is interesting is for homes that sold last year, the asking price, the seller received over 97% of their asking price, 97.5%. So that tells you, because of the supply demand dynamic I was talking about, sellers had a good amount of leverage and were pretty close to getting the asking price. As far as 2023, of course, no one has a crystal ball. Rates have started to come down some. The association here projects maybe 5.5% as a target for 23. Probably the encouraging thing is that the supply is coming back up. So there's more options for buyers, as well as if mortgage rates come down a little. So that's realty. Quick update on farmland from realtors that work exclusively in that area. Farmland last year, overall prices were up across the board. The land around cities, so if you think of all the development again around Des Moines or around Iowa City or around the western side of the state, that land increased the most. It's in the most demand. The number of sales did decrease year over year. So while prices went up, the number of sales when we're talking about farm transactions went down. And of course, a lot of that has to do with rates. Looking forward to 2023, what they're projecting is because of where rates are at, lower quality land is probably going to level off in terms of price, but they still expect the high quality land to continue rising in price. So I know we have a lot of people here that come from a farming background, or maybe that's in your family. Good information to have there. Another question people are curious about, if we go into a recession at some point, how does that affect farmland? And their view is that a recession in and of itself would not really affect the price of farmland. Of course, if commodity prices get hit hard, corn, etc., now that will drive down the value of or the prices of farmland. So that's something to keep in mind. And the last thing, you're starting to see stories or hear in the news about people from outside the state that are buying farmland, investment groups, right? There was just, any of you sports fans, there was just a story in the last week about a group of professional athletes. I think the most well-known was Joe Burrow, quarterback for the Bengals. They played in the Super Bowl last year. A group of athletes bought some farmland in northern Iowa. And so we are starting to see more of that. But what they're seeing is still the majority of sales of farmland in this state are still local buyers. But there has been a small increase in the out-of-state buyers coming in. And it's a mix of what they're interested in between tillable land and also some recreational land. So that's the update on farmland.
We have an update from the accountants also. So I'm going to talk about taxes, but I'm going to talk about in two different ways: federal taxes and state taxes. There's really not a lot of changes right now in the federal taxes. One of the changes is from inflation because many things in the tax code are linked or have an inflation built in. So essentially what's happened is the tax brackets have gone up about 10% from the years 2021 to the years 2023, which means that each bracket of number that your income falls in has gotten wider. So in essence, most people, if your income stays the same, are likely to see a decrease in their effective income tax in 2023. Okay, so that's kind of good. There are, however, big changes for Iowa taxpayers. Starting in 2023, Iowa taxpayers will begin to see a rate reduction. Over the next 4 years, Iowa will remove the top tax bracket until it reaches a single rate of 3.9% on your income taxes. This is for all taxpayers in Iowa. The downside is that you no longer get a deduction on your Iowa taxes for what you pay in federal taxes. So there's a bit of an offset there. Rates are coming down. However, you lose a pretty big deduction. In fact, most people's biggest deduction on their Iowa taxes. So, but we do still expect many Iowa taxpayers to see an effective tax decrease of about a 0.5 percentage point. Okay. Now, starting in 2023, all qualifying retirement income, still waiting on final language for what that includes, for individuals over the age of 55 will not be subject to Iowa tax. As it sits right now, Social Security and military pensions have always been exempt from Iowa tax, but the tax withholding rules have still not been updated. So it's a typical government thing, right? One arm passes a law and all of a sudden you can't put the law into effect because all the rules that govern the law haven't changed either. So they're working through that. And this accountant expects in the second quarter or third quarter, the withholding tax tables will be updated. And so you should see what he's saying is it's not going to be taxable in 2023, but you're still going to have it withheld for a while. That's kind of what I'm hearing. So this retirement income, which is a big deal, would include IRA and 401k distributions, IPERS distributions, pensions, and railroad retirements. So a lot going on, especially in the Iowa tax. And last, we have Dan Holtkamp from JP Morgan is going to give just JP Morgan's outlook on the future.
Thank you, Guy. And thank you, everybody, for being here. Just to wrap it up in the next couple minutes before we take your questions, we spent a lot of time talking about the economy and when and if there may be a recession. We talked about the implications of COVID and high prices and inflation and the rapidly rising rates. And so because of all these things are very backward looking, that's impacted the market last year. And so I think moving forward, while last year was an extremely challenging year for the stock market and bond market, in fact, very rare. In fact, this is the first time in 50 years that a 60 stock, 40 bond is negative when both a stock and bonds are negative. And so what that means is for even conservative investors, if you said, hey, I don't want to lose a lot of money, I want to be safe, you lost money on the bonds, you lost money on the safe investments. So last year was an extremely rare year, but it's JP Morgan's view that despite the challenges in the market, a lot of the bad news is priced in. And we believe for balanced investors that this represents the best opportunity to get invested anytime we've seen in the last 15 years, even going back to where we were back in 08, 09. Again, investing after the crisis in 08, 09, it took a lot of guts. But to Kurt's point at the beginning, having those guts and not letting your emotions control when to invest, I think ultimately that's the best advice I would have. And so, Caleb, if you turn to the next page, just looking at the stock market, after every bear market, and at the right, you can see 15 bear markets in the last 100 years, there's always a bull market that follows. I know those numbers are small, but trust me on this, the bull markets are not only significantly longer, they're significantly stronger than those bear market counterparts. And so the fact is we will recover, your accounts will recover. It just might take some time. And we all loved it after the COVID downturn when the market really shot up, right? This one might take a little longer, but let's say it takes 2 more years just to get back to where we were a year ago. If you invested today and it took 2 more years, you would receive a little over 11% per year. If it took 3 years, or maybe let's say it takes longer, let's say it takes 4 years, you'd still be looking at a nearly 7% rate of return per year just to get back the highs. And chances are, if it does recover, it's not going to stop at the highs. It's going to go significantly beyond that. And so, again, I realize there's a lot of concern around recession and what the Fed's doing and around interest rate policy. But again, investing when you're a little fearful, that's where the opportunity is at. And that's what we see today on the stock market. Go to the next page. Let's go one more. The bond market, this just shows how significant the declines were. These gray bars show you the returns you make in bonds in a given year going back 50 years. Last year, down 13%, was the worst year ever in bonds. Not the worst year in the last 20 or 30 years. It was the worst year on record. Now, what we know is after a down year, the following year is quite strong. We've already seen it this year where everybody's expecting the economy to slow, and actually interest rates have come back down some, pushing bond prices higher. And so we've had a good start to the year on bonds. We'll see what happens for the rest of the year. But I think if you are looking for safety, whether it's CDs, whether it's money markets, or even bonds, it does represent some pretty attractive opportunities. So I'll leave it at that. I'll bring up the rest of the advisors. We'd love to take any questions if there's any folks that would like to ask a burning question.
Thanks, Dan. Caleb, did you have any questions come in? I know we had one about inflation, right? So I'll just take, yeah. So one question people have related to inflation is when we're doing financial planning, how do we take that into account? To what degree do we? First of all, everything's case by case, right? So if there's a scenario where we're doing planning for someone where we want to build out or project a high level of inflation, we can do that. The tools we use are totally flexible. Usually the average inflation rate we use is 3% if we're going to just speak generally high level. And that is more than what the historical rate has been. And we do that once again to err on the side of caution. So if there's a surprise long-term with projections as it relates to inflation, the surprise is to the upside. So I know that was one question.
For a long-term investor and looking at where we are right now, in my view, the factors that really need to be looked at are dividends and valuations. So markets, the style of investing that's popular, the types of companies that receive flows from investors, that goes in waves. And we are coming out of a pretty prolonged wave where rather than buy low, sell high, the whole thing was, if you wanted to make big money, you needed to be willing to buy high and sell higher. And so what I mean by that is all of the investment flows were going to a lot of very fast growing companies, many of which don't really have profits. Their businesses are still growing rapidly in terms of sales. They have growing top lines, but no profits. And that's where the money was going in the stock market for a long time. And clients who were invested in mature companies that have strong, stable cash flows, pay dividends, they weren't seeing anywhere near the market appreciation levels in their portfolios. Yes, they were enjoying dividends, but they weren't getting the returns that they're seeing advertised from, the S&P 500 index or the NASDAQ index. But those companies, those high growth companies have had their comeuppance through all this. Now investors are starting to look for earnings. We can look at last year, and we can take the S&P 500, those 500 companies, and we can split them into two groups. Those fast growing ones, small profits, maybe none at all, versus the stable slow growers. And the index was down last year, what, 20%? But the growth companies were down almost 30, and the strong dividend payers were down 6. That's a huge, huge gap in performance. So now we're starting to see that. And as we look forward and we move forward in this regime where we don't have free money anymore, interest rates aren't at zero and being held at zero, money costs something, that's normal. And during periods of normal interest rates, we would expect stock returns to be less, to be lower. There was no alternative when people couldn't put money in bonds and expect to make anything. You saw what CD rates became at the banks with rates near zero and held there by the policy of the Fed. Well, that's not normal. In a normal environment, stocks will not rise as fast because there is an alternative. People don't have to put all their money at risk and to get a return on it. And so in an environment like that, these companies that don't have profits aren't going to rise to the values that they have been. And the best evidence that a company is strong and profitable is dividends. You can't fake a dividend. You have to have cash to pay it out of. And where does the cash come from? It comes from profits. And so looking forward, long-term investors, I think the pendulum has swung back. We're going to see these stronger companies. They're going to do better. And you're going to always have that dividend income, which is going to be a big part of the investment return in a lower return environment.
I agree, and I'll add on to that and add a few things, but we've really come full circle. We went through a period of a lot of strangeness, right? Of distorted markets, of COVID and a shutdown, a lot of stimulus. It kind of feels like we're suffering a hangover from COVID. That's what it feels like, right? A lot of money got injected to the system. It distorted markets, but things are getting back to normal. And here's a little data point. The cost it takes to ship a container. Everybody know what a container is, big metal box. They ship them across from US to United States and back. In 19, it cost $1,500 to ship a container full of goods from China to the US. At the peak of the coronavirus, it jumped up to $15,000, the cost. And now guess what it is again? It's actually $1,400. So we're seeing a normalization from COVID that was unprecedented. And what Steve is saying is we're getting back to normal. Inflation is coming down. We're starting to see the numbers come down. In fact, goods inflation is really, really dropping off a cliff. Now, service inflation is staying a little higher. Remember, because we talked about the chronic worker shortage. You need workers to give service, to sell a service. And so those costs are continuing to go up. But I feel like we're entering a more normal situation, more normal interest rates, more normal market environment than we've seen in a long time. So
See things on both sides of people concerned with the deficit and then how that rolls over into the debt, the national debt. Some people are really freaked out about it. Some people say, hey, it's there. We're not going to go under. What do you guys, I mean, you're looking at your weekly meetings. I imagine your dartboard is hidden around here somewhere that you're picking things with, but how do you guys factor all that stuff in? And what do you guys think about the deficit and that?
My personal views of the deficit and the debt, I mean, it's got to stop somewhere. It has to have limits. But I have always tried to make this point to clients when they're asking similar questions. Well, what about this debt that we're building up? Well, there's a difference between a government entity and our personal households when it comes to how we have to look at debt. Greg, if you die and you got a bunch of debt, well, your estate has to take care of that debt. And your creditors are going to come and they're going to look at your assets and they're going to say, which of these can we claim to get repaid back as much as there is? Well, a government doesn't have an expiration date on it. We all do. And so the government can just keep getting by rolling the debt. And, you know, we haven't paid back any of our debt. We just keep rolling it. We refinance it. And so theoretically that can go forever, but there are economic consequences to, you know, having more debt and spending more than your economy produces every year. That's the equivalent of a household spending more than they bring in. And so, yeah, there are consequences that go with it. But as far as when I hear people say, we're never going to pay back the national debt, they're absolutely right. And we're not even going to try. We're going to consider it a victory if we can just keep successfully rolling it. Other questions?
A guy had mentioned the state of Iowa in 2023, maybe no longer tax-free for retirement income. And one thing I've seen, maybe you said maybe that's still being defined, but I maybe had seen something that with respects to a Roth IRA conversion, that would not be a taxable income in 2023 in Iowa. Is that correct? Or have you seen anything along that regard?
I think this is a new enough law. There's some areas that the accountants and the government still haven't lined up on. So I think that's a to be determined. Cause yeah, I think it's the devil's in the details, right? So as the rules get written to put this into effect, then we'll see how that turns out.
I'm wondering if the investment committee has any consensus or maybe majority feeling about what will continue with interest rates in the Fed into 2023. They were obviously pretty aggressive in 2022. I'm wondering if they're going to carry forward with that further in 2023, or if you see an end to that soon.
Well, that's of course the question of the day, right? Because if you knew exactly what it was, then you could do everything right. There seems to be a disconnect between what the Federal Reserve is saying. They're saying, hey, we're going to be serious and stamp out inflation till it gets back down to 2%. That's our goal. The market says, ooh, we're already seeing inflation come down quite a bit. We think you might be overshooting if you keep going. So that's the struggle right now, what the Fed's saying and what the market's hearing. They are not lining up.
I will add just one thing to what Guy just said. If we're looking for, if somebody asked me to predict where will the Fed stop, I would say it's where the inflation rate and the federal funds rate meet. And so so with inflation coming down and the Fed continuing to tighten, the idea is at some point they'll meet. And at that point, that's where we have a real interest rate, meaning an inflation adjusted interest rate of 0. We've never seen a Fed rate tightening cycle stop with a negative real return. We've always had a positive real return where the Fed has stopped tightening.
Yeah, I think this would be a good place to wrap. If you have other questions, feel free to ask us. And I didn't want all of you to leave or those watching to get away without knowing that we really appreciate your business. And thank you for choosing Compass and for spreading our name around town in a good way. We love that and we really appreciate it. So until next time, Happy New Year.